Okay, I'm going to use Excel to go through some of those examples so that we can look at how different transactions affect the accounting equation. We're going to practice making financial statements, and then we're again going to look at how different transactions affect the accounting equation. This Excel template is available in Canvas, so you can work in Excel and practice learning these skills while you're watching this video or after you're watching this video. I want you to become comfortable with Excel. So we have this first transaction. Owner invests $80,000 in the business and received 8,000 shares of stock at $10 per share. So we have $80,000 in cash, and we now have $80,000 in capital stock. So we have $80,000 in assets and $80,000 in total liabilities and equity. Our accounting equation balances. On January 21st, we purchased land from the city for $52,000 in cash. Now we have land of $52,000, and we have cash of, well, we had 80,000. I'm putting in an equation here if you can see that. So I started with the equal sign. We had 80,000 and we spent 52,000 on land. So now we have 28,000 in cash left over. Our capital stock has not changed. So now we have 80,000 in equity, and we still have 80,000 in assets. We've just changed where that 80,000 is placed. Okay. Now, on January 22nd, we purchased an old garage building for $36,000. We paid $6,000 in cash. We issued a 90-day note payable for the remaining amount owned. Now remember, I said a liability is anytime we owe people money. So now we have a liability of $30,000. We still have capital stock of $80,000. We still have land at $52,000. Now we have a building worth $36,000. And we have $6,000 less in cash because we paid $6,000 in cash. Our accounting equation still balances. So we still have equal liabilities plus equity and assets. The next transaction. On January 23rd, we purchased tools and automotive repair equipment for $13,800 on account due within 60 days. So now we have $13,800 in tools, and we owe $13,800 for those tools. Other accounts have gone unchanged right now. So we increased our assets $13,800 and we increased liabilities $13,800. Our accounting equation is still true. On January 24th, we sold some of those new tools to Ace Towing for $1,800. They agreed to pay us that amount in 45 days. When someone owes us money, it's called an accounts receivable. So we have our cash didn't change as part of that because all we have is a promise that they're going to pay in 45 days. That's called an accounts receivable when someone promises that they're going to pay us cash eventually. So we had $13,800 in tools and we sold 1,800 of them. So we're going to subtract that out. Now we have 12,000 in tools. We still have our building. And then nothing changed about any of our other information. Okay, now we have on January 26th, we were paid $600 for this accounts receivable. So we received $600 in cash. So now our cash has increased $600. And we have $600 less on this. So now they only owe us $1,200. And then I'm going to teach you a little trick here. So I don't have to type in all of these numbers. I'm going to equals that. I'm going to put enter, and then I'm going to drag this corner across and let that autofill. So that's an Excel shortcut that you've learned now. Okay. Then we have our company made a partial payment of $6,800 on its accounts payable to Snappy Tools. So we gave them cash. We have less cash now, so minus $6,800. This is still the same. So I'm going to copy and paste, and then the next one we're going to change is the accounts payable. So we paid $6,800 of this, so we owe less money now. Okay, and if we took the time to add the assets equals liabilities plus equity, our accounting equation would still balance. Now we have overnight recorded auto repair services of $2,200. We received cash. So people paid us for services in cash. Okay. So we did work. So we're adding cash this time. And then we're going to copy all of these. So now the account that gets affected when we sell things as a company and get cash is this retained earnings account. So now we have $2,200 in revenues. Okay. Now we're going to pay expenses. We pay these expenses in cash, so our cash is going to decrease by the amount of our expenses, or $1,400. All of our other accounts are going to remain the same with no changes. And expenses, revenue and expenses affect retained earnings. So that goes against our, so now we have $800 in retained earnings. So $2,200 minus $1,400 in expenses gives us remaining income of $800. So that's an example of how those different transactions affect different accounts. In the next video, we're going to do the financial statements.